Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss in depth withdrawing money from an annuity and talk about the different types of annuity contracts out there, and then when individuals take money from them, some of the mistakes to avoid and how to make sure that you're not getting handcuffed into a product and you're able to kind of leverage more control rather than have all that control go over to the insurance company. So I'm going to be talking about a different blend of topics during this video, regarding whether somebody's triggering immediate income, whether they're utilizing income rider, whether they're just using a fixed account and just taking interest from those accounts, or an index account and just taking the interest gained that year. So there's a whole plethora of options that an individual can leverage. The takeaway that I want you guys to get from this video is understanding that you have a whole slew of annuity options out there, and there's never going to be a one size fits all for you and everybody else. It really just depends upon a case by case basis. But hopefully this video will help you understand, okay, if I'm going this route, this is kind of different things to look for. As I clear off my screen, I want you to understand that an individual could leverage their retirement monies, such as old 401ks, IRAs, 403bs. They could leverage those types of monies. They're known as qualified retirement accounts, and you could place it over into a specifically designed IRA annuity with all these options that I'm talking about. The opposite end of the coin, the non-qualified accounts, such as cash accounts. If you sold a business, if you sold a house, if you sold, something worth of value, and now you have this cash that's sitting there, you could establish something known as a non-qualified annuity contract. So, depending upon what sort of monies it's coming from, that's where you're going to want to categorize that specific annuity. But it's not like an annuity is its own entity. It's not like it's just an annuity you could only use cash, or an annuity you could only use qualified funds. You can use those types, for both, but or even like a Roth IRA annuity as an example. So understand that you could use those types of monies all for annuity contracts. The different things that I want to discuss are immediate annuities. We want to talk about fixed annuities, fixed index annuities, and then income riders, how to utilize income through income riders on annuities through either a variable or a FIA that I call the hybrid annuity. The immediate annuity is the most basic type of annuity, and this is where a lot of individuals today get confused, thinking that all annuity contracts are like an immediate annuity. I personally don't like immediate annuities. I think it gives too much control to the insurance company. Sometimes you might be able to get the most amount of income if you're looking to trigger income like within 30 days or a year, but usually if you're going out, if you defer it at least 1 year, there's a couple of better options out there for you, and it gives you much better control. So what I mean by that is an immediate annuity, and the whole purpose of an annuity is to generate income, is to provide you lifetime income or provide you income that you could never outlive. So it's the complete opposite of life insurance. Insurance companies offer life insurance to say if an individual goes and pays a premium dollar on a monthly basis, on an annual basis, and they were to unfortunately pass away, well, then a lump sum is going to get paid out tax-free to their beneficiaries. With an annuity, what's happening is an individual is taking a lump sum, whether that's from those qualified accounts or those non-qualified accounts, and then they're purchasing a annuity contract that will provide them subsequent payments. So the way that those payments work, like if you have an immediate annuity, and let's say you have just a very basic single life only immediate annuity, and you have an individual that, he or she is age 60, well, and they have, let's say, $100,000. If this person had $100,000 and put it underneath their mattress and said, okay, I'm going to try to not outlive this money that's underneath my mattress, I'm going to try to pull out, $5,000 each and every year to the day I die. Well, obviously that's a problem because there's nothing that's actually increasing that value. And right in that very easy example, after 20 years, this individual has no more money left. So after age 80, they have no more money left. So what an immediate annuity does is they say, we're an insurance company. We understand the law of large numbers and actuarial data. If you go and you're taking on a risk, you could purchase an immediate annuity contract, and we're going to annuitize your payments, meaning that this $100,000 for male, female, age 60, we're going to pay you $7,000 to the day that you pass away. So what happens is if this individual keeps living and living and living, they live past their 70s, live past their 80s, let's say they live to 105 years old, well, they would have been getting paid that $7,000 each and every year to the day that they pass away. That was the agreement that was set up, that was established through the insurance company, which sounds pretty good, but understand they know the chips. They control the chips. They know all the actuarial data to the decimal point to know when, if we have 1 million clients, okay, which ones are going to pass away before that break-even points and which ones are not. So essentially, they're going to be able to leverage these dollars invested on the back end through their company, and then on top of it, leverage the law of large numbers to always be profitable. So with that specific example, let's say if an individual's age 60, they triggered this sort of income, and then all of a sudden they come down with an ailment at age 61 and they pass away. Well, this says that the insurance company, part of their agreement was they paid $7,000 for the rest of that individual's life. They paid one payment and all of a sudden that person passes away. Well, now $93,000 of profit goes to the insurance company and nothing goes to the beneficiaries. So that's a problem that individuals do not like. There's ways on how you could leverage an immediate annuity. You could do like a combination. You could leverage also life insurance with it. So like a way on how you could withdraw money from an immediate annuity is you could withdraw it, you could have that sort of provision, but then also make sure that you're having a life insurance policy set up on that annuitant as well to say, God forbid if they were to pass away, well now you have a benefit, a tax-free benefit that would go to their beneficiaries, and therefore they could use that benefit to therefore purchase a new policy. So what I mean by that, if you go and you have an individual that's age 60 that's healthy, it only works if the person's healthy. If this individual is age 60 and let's say they use $100,000 as that example, and they're getting paid $7,000 per year of lifetime income, well, maybe this individual could take $500 out of that and purchase something known as a GUL policy. So it's like a permanent life insurance policy with no cash value. So it's a lot cheaper than like the typical whole lives, so the IULs and the GIULs and the variable universal lives and all that stuff. And let's say in this hypothetical example, they're using $500 a month, and now that's going to purchase a $200,000 death benefit GUL. So what happens is this individual is going to be netting $6,500 each and every year for the rest of their life. God forbid, whenever they pass away, now their beneficiary can receive $200,000 of a lump sum. At that point in time, they could take another $100,000, and that beneficiary could therefore purchase their own annuity contract. So that's where it works out successfully. It's known as an arbitrage strategy, and it's very similar to what I recommend for individuals on pension plans, because a pension plan is nothing but a glorified, immediate annuity or a DIA, deferred income annuity, depending upon if you're trying to utilize single life or joint life options. So typically that works a little bit more favorable than triggering a joint life option, but once again, that individual has to be insurable. So that kind of solves that problem regarding the immediate annuity. The fixed annuity, these fixed annuities were established to kind of combat that space that the bank CDs were taking from insurance companies. And what I mean by that is, like, if an individual goes and they had a 5-year bank CD in the 80s and the 90s, and let's say those bank CDs were paying, 8%, 10% rate of returns. Well, this individual knows if they have $100,000 as an example, and they were in a 10% bank CD for 5 years, will they be getting paid $10,000 per year each and every year for the next 5 years? They would have gotten paid a total of $10,000 per year, $50,000 total, and then they have their $100,000 that's still sitting there that they didn't have to dip into their principal. So that's when interest rates were really high. So you had fixed annuities that came out. Bank CDs obviously have to be owned by a bank. Banks cannot offer annuity contracts, just like insurance companies cannot offer certificates of deposit, CDs. So insurance companies typically have about 2 to 3% higher than bank CDs with that same, and they have very safe provisions as well. So what it says is that same $100,000, rather than go into a bank CD, this individual can place it into a fixed annuity that, instead of paying 10% at that time, was paying 12%, and therefore 12 is higher than 10. So that's why, a lot of companies used to leverage that fixed annuity space and say, I just want to live off of my interest, not dip into my principal. So that in that example, $100,000, they're getting $12,000 per year. They're pulling off that interest, pulling off that interest, pulling off that interest. After 5 years, they would have received all that income, and still have $100,000 to reinvest into a new, 5-year fixed annuity or 5-year bank CD. So what advisors used to do back in the 80s and 90s is they used to deem themselves retirement income specialists, and you could have a random banker. That's why bankers are so popular. Bankers and insurance agents that would essentially say, okay, what we're going to do is we understand the longer that you lock your money up, the more interest credit that you would receive. So what they would do is establish a laddering strategy to give that person some liquidity, meaning easy access to their monies, and then also have some good interest credit. So like if you had a 1 year, rather than use, let's say if somebody had $500,000, rather than place all that 500,000 into a 5-year bank CD that's paying 12%, what they would do is splice this up into $100,000 increments. It's just an easy example, and they'd have them purchase $100,000 1 year, $100,000 2 year, $100,000 3 year, etc., etc. So what this says is the 1-year CD might be paying 6%, 2-year 8%, 3-year, let's say 9%, 4-year 10%, 5-year 12%. So what this does is this individual is able to live off all this interest. After that 1 year suffices, they take this $100,000 and then they purchase a new $100,000 5-year CD. So that this one is going to be 12%. There's no more 6% there anymore. And now you have 5 different annuity contracts. And then eventually you could have liquid cash that is now looking like a 1-year increment. Each and every year they would just purchase a new 5-year CD. It was known as a laddering strategy. It was very successful. Well, the problem that has lied since that point is interest rates have hit rock bottom. So now you have a 5-year bank CD that's paying 1.2%. You have, a 5-year annuity, fixed annuity that's paying about 3%. So you're not able to really leverage the fixed interest credits anymore. If interest rates increase again and you start to see those 6, 8%, 10% numbers, well then this is going to be a really easy, viable solution. It's going to make advisors look like geniuses, even though it's just such a simple concept of you just using fixed accounts to therefore provide income and never dip into the principal. So you can leave that principal, as a type of benefit or to your beneficiaries. So a solution on the fixed annuity side could be to find the sweet spot. And what I mean by that is you have these products known as fixed annuities known as MYGAs, where they're going to consistently pay you that fixed rate of return each and every year. And dependent upon the month or the week that you're looking to purchase these things, you might have a sweet spot with a 5-year product. You might have a sweet spot with a 7-year product, with an 8-year product, with a 4-year product. So you might have something that is like a 5-year product that's paying 3%, even though the 7-year products are only paying 2.90%. So it kind of doesn't make sense regarding the longer that you're locking it up, the more interest credit that you're receiving. Some carriers just really want to have that 5-year space or that 7-year space or that 8-year space where you could kind of find these little sweet spots that are paying right around that 3.5% interest rates that you'd be receiving on your accounts each and every year. And then if you're fine with living off of that, then you understand that you could use that income each and every year off of that small percentage, that 3.5%, and never dip into your principal and just constantly do that laddering type strategy. So, it's really aggravated people because they can't get those rates of return like they used to, and everything is kind of really, seesawed on the opposite direction, saying that interest rates are all-time lows, which isn't necessarily a bad thing when you're talking about other variables in the market. But regarding that retirement income, that fixed income space, that's where it gets a little bit frustrating for seniors. So a way on how insurance companies tried to combat that low interest rate environment was to try to tie that interest rate to some sort of market movements without risking your principal, without risking a specific negative that could come back. And what I'm talking about is something known as a fixed index annuity. And a fixed index annuity, if we're using like $100,000, we'll call it a 5-year example, and we're versing, a fixed versus a fixed index annuity, why would somebody go with the fixed index annuity? Well, what happens is, let's say this fixed index annuity has something known as a 10% cap and a 0% floor. And let's say that this 5-year $100,000 fixed annuity was paying us exactly 3% per year. So we understand after the first year, that account value is looking at, or this person made $3,000. The next year they made, depending upon if they left it in that account or they were just pulling out the interest, another $3,000, et cetera, et cetera, et cetera. So if they kept living off of this interest on the fixed annuity, like I just explained, they would receive $15,000 total after the 5 years, and they would have access to the 100 grand left over. The 5-year fixed index annuity, and this is just a really easy hypothetical example. Let's say that this fixed index annuity had an S&P 500, was tied to the S&P 500 indexing strategies with a 10% cap, 0% floor. And let's say the S&P 500 gained 20% the first year, then lost 50%, then gained 7%, then lost 6%, then gained 11%. Well, with that specific account, if we had a 10% cap, 0% floor, your interest credit for the first year would be 10%. The second year would be plus 0% because it was negative. So you have that floor of 0%. The next year you have plus 7%. The next year you have plus 0%. And then the next year you have plus 10%. Because you can never go above, what that cap is. So what this tells us is it allows the individual to take out income more sporadically, or maybe say, hey, all I need is 5% this first year, even though I gained 10. So I'll just take out, that $5,000 for income. The next year when I gain 0, I'll use that other $5,000 of interest that I gained the first year. The next year I'll gain 5,000. I have 2% left over. This next year they might have to dip into, they might be subject to only 2 grand, or take 2,000 plus some principal, and then that fifth year they received a nice large gain again. So total, this is going to give the individual a plus 27% gain versus the plus 15% gain total on the fixed annuity. So it allows that individual to gain when the market goes up to a specific limit and not lose anything when that market goes down. So you have a bunch of really neat FIA contracts out there currently, and we help individuals try to figure out what's their sweet spot for their particular age, for their particular area, and seeing whether or not it makes more sense to go into like a MYGA-based product or a fixed index annuity type product, for that peace of mind that if the market goes hell in a handbasket, I'm not losing my shirt, I'm not losing my principal, I'm just essentially gaining 0% that year. The market goes up, well then I could maybe splurge a little bit for that next year. So you could kind of do it more sporadically. The problem that lies with that FIA space is you have extremely low caps with companies. So you have, with any annuity contracts, you have over 1,200 different options. And let's say you have, 500 options in your state regarding the FIA side. Well, majority of those are going to be garbage contracts, meaning, you might have like a 2% cap with a 0% floor, something that the insurance company is just leveraging the heck out of their chips, and they're beating you over the head, making you lose control, making it sound like it was this fantastic product. So there are specific sweet spots per carrier. It depends upon which month, which week that you're looking to place these things in there, your money's in there, and making sure that you're getting locked into a good contract. So saying if that company was to change it in the future, well, you still are set up with that good contractual guarantee at inception when you establish that contract. So, it's very important to understand that you have a bunch of crap out there, and then you have good contracts. Sometimes you have companies that are crappy companies or crappy contracts for the longest time, and now all of a sudden they want to get into that space, and then they'll offer a really good like a fire sale for that 1 month or for 2 months total, and then so it allows an individual to get set up with that contract, and then they will get out of that space or reduce their rates further. So it happens all the time. That's what we specialize on, is making sure that we're having our eye on the best possible contracts out there to say, yes, if you're looking this route, this is going to be the ideal solution for your exact goals. Now, the final type of annuity contract that you could utilize monies from is using an income rider, and these came out in early 2000s. They originally came out with variable annuities. I hate variable annuities. They used to be favorable, but it's a lot of hidden fees with variable annuities. You have downward market loss potential. You have a combination of those fees, the advisor fees. You could have that downward market loss, and you're pulling money from those accounts, so it tries to liquidate that account as quick as possible. The hybrid annuities that I like to use is that concept of a fixed index annuity with an income rider. So your physical money is gaining when the market goes up, gains 0% when the market goes down, like I told you in the, when I was doing that comparison between the fixed and fixed index. but you have this income rider for those individuals that say, I hate annuitization. I hate that solution where I have $100,000, I'm age 60, the insurance company's paying me 7 grand, but if I croak after a year, my beneficiaries receive nothing. Well, that's what an income rider allows you to do, is give you that peace of mind and also provide you control and growth onto your account at the same time. So maybe a fixed index annuity with an income rider, if you wanted to trigger that within 30 days or within the year, and this individual is age 60, well, maybe they might not pay 7 grand. Maybe it might be like $6,800, but this insurance company is paying them $6,800 each and every year till the day that they pass away. Let's say if they passed away after the first year, they only, took out 12 grand from total from their account, and they had $100,000, and let's say their account didn't gain anything. Well, this $88,000, rather than have that go back to the insurance company, this money would be left over to the beneficiaries. Let's say if they come into an oh my gosh moment and they have to pull out extra income, well, they would be able to have better liquidity on this. Usually it's about 10% liquid access to your account within the first couple of years, depending upon your surrender charges. So maybe say if you're in a 7-year product, it'll give you 10% free withdrawals within the first 7 years, and then you have full access to these monies after that 7th year or after that 10th year, depending upon how long you set up your money. So there's ways on how these income riders are established. There's a lot of smoke and mirrors out there where you might have heard of like an 8% annuity guarantee or 7% annuity guarantee. And what it's saying is it's just a way on how that company is doing their calculation account on their lifetime income rider. So just be very careful with that. But ultimately, the very basic components of a hybrid annuity is you could go and you have sweet spots for an individual that's 60 that wants to trigger income at age 63. Well, there might be a really good company that has a really good 3-year deferred product for a male, female age 60 that's looking to trigger lifetime income. Let's say if an individual wants to trigger income at age 67, they're currently age 60 and they want to leverage, 401k accounts, so they want to leverage a cash account. Well, that could be entirely 10 different options, that the 10 top options could be different for that triggering at age 67 than it would be triggering at age 63. So there's just a whole plethora of options available for individuals. So in closing, I want you guys to just understand these basics. And at any point in time, if you found value in a specific route, you could give our 1-800 number a call. You say, it's 1-800-566-1002. You talk to an assistant. You'd say, okay, I watched the video online and I was interested in, trying to figure out a way to withdraw money from an annuity. I'm not really sure what an annuity is or whether or not it might be beneficial for my situation. And then that assistant is going to patch you over to a specialist. And then that specialist is going to walk you through, okay, what's your current situation? What are some of the different things you're trying to accomplish? And whether or not an annuity might make sense or a different avenue might make sense, or whether you should just stay exactly put and not change a single thing. And so we try to take a really ethical approach. We're A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. We try to educate you guys through personalized videos, through literature pieces, making sure that it's transparency. You guys understand the process that we're trying to show you, and then so you're educated. So it's not just like we're beating you over the head with a hammer saying, oh no, listen to us, we're great, we're great, we're great. It's no, what's your situation? Do you see it clearly, kind of the angle that we're seeing, the 30,000-foot view to get from point A to point B successfully, and making sure that you could retire with confidence. So I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. And once again, our 1-800 number is available 24 hours a day, 7 days a week. Give us a call, mornings, nights, weekends, holidays, and someone will be there to take your call. Thank you so much for watching, and hope you enjoyed.